In options, there are two different prices that we have to be aware of and not get confused when we are processing settlements in option trades. Hello everybody, I'm your learning partner Sushila Hariharan, and if you're interested in a career in investment banking, trade life cycle, hedge funds and OTC derivatives, do consider subscribing to my YouTube channel where I have been providing research focused content centric videos on these topics. We are aware of what are options. An option is a derivative product and it is traded separately in the F&O segment of the market, and options are a financial product whose price is derived from the underlying asset. And most importantly, the biggest feature of an option is, just like the English word option, we have a choice whether to exercise or not to exercise the option. So therefore, there are two distinct prices that come into the picture over here. In an option, there are two entities, the buyer and the seller of the option. So the buyer has all the rights whether to exercise or not exercise the option. The seller is giving the buyer all these rights. And since the seller is selling away his rights, the buyer must pay the seller the premium always, irrespective of whether the option is exercised or not exercised. So, what determines the moneyness of the option, or whether whether the option is going to be exercised or is it going to be allowed to lapse by the buyer, is the difference between the strike price and the spot price. The strike price, also called as the exercise price, is the price at which the option is entered into. The spot price is the price of the underlying asset in the underlying cash market. So these are two distinct prices. In some markets we use the word strike price, in other markets we use the word exercise price. Both mean exactly the same thing. The spot price, on the other hand, is the price at which the asset is being traded in the underlying market. I already just explained to you that the options is separately traded. It's a financial contract, and therefore its trading and its exercisability is closely linked to the spot price prevailing on any day right up to expiry if it is an American option. So let's consider this. In a call option, which gives the buyer the right to buy the underlying asset, then if the strike price is lower than the spot price, obviously the buyer of the option who has the right to exercise the option will do so. Such an option which will be exercised is called as an in the money option. On the other hand, if the buyer of a call option is facing a situation where the strike price of the option is higher than the spot price of the option, in this case, they will find that the option is actually not worth exercising because the market price is way lower than the price of the option. Then why will they exercise the option? And any which ways the premium is a sunk cost, so they just allow the option to lapse worthless. Have we understood this? So there will be a continuous comparison of the strike price versus the spot price and linked to the market price right from the day of entering into the trade up to the settlement date or up to the expiry date. What about a put option, which gives the buyer the right to sell the underlying asset? In the case of a put option, if the buyer is buying a right to sell the underlying asset and the strike price of the option is much higher than the spot price, naturally they will exercise the put option. Whereas in the case of a put option where the strike price is lower than the spot price, on that very day itself, if it's an American option, the buyer of the put option will immediately want to allow the option to lapse worthless because they can sell the underlying asset in the marketplace at a much lower price, at a much higher price. Therefore, the option of the put, the price of the put option, the strike price of the put option, which was lower than the spot price of the put option, will expire worthless. Such an option which has got no moneyness in it, and there is absolutely no incentive for the buyer of the option to exercise the option, is called as an out of the money option. So in this case, we find that in the money options are exercised by the buyer of the option, and out of the money options are allowed to lapse by the buyer of the option. Then what does the seller do? The seller does whatever the buyer wants, because the seller has surrendered all the rights in return for a price that he has collected from the buyer at the time of entering into the contract itself. So these two prices, the strike price and the spot price, must be known by the investors before entering into the F&O, especially into the options segment.